The Zacks rank, value, momentum, growth, and income all factor into Zacks rank buys.
Well, if you're looking for stocks that have some value in them in this market environment, you may want to consider a couple that our value strategist Tracey Ryniec has come up with for your review. You're going to fill us in on a couple now. Manpower is one of them.
Yes, Manpower Staffing Agency. They are big in Europe, though, so that has always been kind of their thing. I think they used to get about 25% of their revenue from France, but the French economy is starting to recover, and Europe itself is starting to recover. So their numbers haven't been that bad. They saw revenues rise about 7% if you strip out the currency issues in the fourth quarter. And last year, 2015, again, there's a lot of currency issues, wasn't so bad for them. You know, the estimates starting to trickle down a little bit here, even though we have the Zacks rank number 2, and that's because the guidance came in a little bit less than expected because of currency mainly, but they don't expect 2016 to be that bad. I mean, you know, it all depends on what's going on in the global economy. We are seeing some issues with the job market, but their permanent staffing is doing real well. They had about 11% gain in North America last quarter with that, and France was about the same, was pretty good, and the UK saw a gain of 18%. So that segment's doing real good. They also do a lot of consulting in these other areas. So, you know, they're bigger than what you think. You can see the estimates kind of trending down a little bit, but we're still supposed to see 3% earnings growth this year, which at least it's better than nothing from what we've seen with a lot of companies, and then jumping up more for 2017. I think they're a little more bullish on 2017. We get through some of these currency issues, and as the global economy hopefully starts to improve by then. The chart, it's been kind of all over the place. We're having, you know, shares have fallen this year, and so that's what is making them cheaper. Has a forward P of about 13. If they fell further, I would be even more intrigued here because obviously I'm getting it at even a lower price. But, you know, pretty interesting value play here if you're willing to take a chance on the improving job market, especially in Europe. And you get a dividend yield with this one, too. Nice little dividend. Yeah, a little bit over 2%. So,
all right.
Not too bad.
Well, all right. That's better than nothing.
Right.
Caterpillar's the next one.
I know. I can't believe I even am doing this one.
Because I was asking you before we started recording here that I mean they've had layoff rounds.
Right. It's been real rough time. Yeah, they've been furloughing people. They were trying to avoid as many layoffs as they could, hoping that the market would turn around, but China just isn't, and that's one of their biggest markets. You know, construction and mining equipment. The miners are just in a really bad place, so that's not going anywhere worldwide. And so they've had to resort to more layoffs in order to cut those costs. That being said, hopefully, you know, we're maybe nearing a low here. This is a cyclical company. You get the ups and the downs, and obviously we're in the down now. The PE doesn't look that cheap here. I kind of looked at it and said, maybe this isn't that cheap because it's 16, almost 17 times, which is higher than the S&P 500. But the price to sales is under 1 at 0.8, and the price to book is under 3. So both of those are real good value indicators. You can see, if I can get it going here, the thing that makes it a Zacks number 2, which I think is the surprising thing, that why it's a buy, is that earnings estimates look like, so far, that they've bottomed, and they're starting to go up. You can see for 2016 that they went from 350 to 390. That's a nice little jump up. And then, again, next year, 2017, I think they're a little bit iffier. We're starting to see a little bit of decline there. But for this year, I think the analysts underestimated what they were going to do, so now they're correcting to the higher side. They're still supposed to see earnings decline about 16%, so you're not getting earnings growth yet, but it does look like the estimate picture is starting to clear itself up a little bit here.
So not really a total disaster.
No. You know, they're still earning money, so and they're able to pay out that dividend yield, which is almost 5% right now.
Yeah, that's a nice
They're holding
dividend
on to that, but they're kind of one of those old, you know, Dow component type companies that the last thing to go will be the dividend. So for now, they are paying out that yield. You can see the chart; it's pretty devastation here. You know, just almost straight down, but we're getting a bounce off these lows. Is this a real bounce? Is this a fake out bounce? I don't know. Like I said, shares are pretty cheap here. They could continue to slide down, especially if we see further problems in China, Brazil also, and the U.S. is holding on, so the market here isn't so bad. So this is one where you're kind of gambling if you're going in there, but the earnings estimate picture is clearing up and looks to be turning around.
All right. Do you own either one?
I do not.
All right. Check out other stock information, stock commentary, picks, stock picking strategies on our website, zacks.com. If you're not there already watching this video, get on over. Link to it all off the homepage. And don't forget, if you're watching our videos on the YouTube platform, you can subscribe to them there and even comment on them. And the feedback's welcome. With Tracey, I'm Terry Ruffalo.